Picture this, it's 9 p.m., you just got back from work, your fridge is empty, and the thought of cooking makes you sad. What do? You open your phone, swipe to your food delivery app, and boom, you're either on Zomato or Swiggy. That's how deeply these two giants have integrated into our lives. But let's rewind a bit. Just 8-10 years ago, this whole idea of getting food and groceries delivered in minutes was almost unthinkable. Come to 2025, we've not only accepted it, we are hooked to it. So now, between Zomato and Swiggy, who's ahead? Which one's making more money? And if you're an investor, which one should you be betting on? Let's break it all down. You're watching Informed Investor, an initiative by Equentis. Before we understand their performance, let's understand how all of this started. First, let's start with Zomato. The story of Zomato began in July 2008 when IITians Dipendra Goyal and Pankaj Chadda, then working at Bain & Company, launched a restaurant listing website called Foodie Bay. Their initial idea stemmed from the frustration of their colleagues who struggled to find menus of different restaurants to order food. What started as a simple online restaurant dictionary quickly transformed into a comprehensive food discovery and delivery platform, eventually going public via an IPO in 2021. Making one of India's most successful tech IPOs at the time of listing with more than 50% listing gains. Amazing, right? Recognizing the potential beyond just food listings and wanting to avoid a potential naming conflict with eBay, the founders rebranded Foodie Bay as Zomato in November 2010. Today, Zomato has expanded well. Food delivery, which is the core business, offers online ordering from restaurants, which was launched in 2015, and also includes restaurant discovery and dining out. In terms of quick commerce, through Blinkit, it delivers groceries and essentials in 10 minutes. Blinkit was launched in 2021 and later acquired by Zomato in 2022. Next is Hyperpure, which is a B2B service providing kitchen supplies to restaurants. Finally, we have Going Out, where Zomato is focusing on the going out experiences. The Zomato District app, launched in November 2023, integrates restaurant discovery and table reservations with event ticketing for movies, concerts, and sports. Another point to highlight is Zomato had the first mover advantage in India's online food ecosystem. By the time food delivery started booming, it had already built strong restaurant partnerships, a loyal user base, and deep market insights. This early lead helped it expand fast and diversify into dining, loyalty programs, and beyond. Swiggy, on the other hand, entered the scene in 2014, founded by Sriharsha Majeti and Nandan Reddy. With a sharply focused approach, while Zomato started with restaurant discovery and later added delivery, Swiggy began by tackling the core challenge, building a reliable logistics network for food delivery from day one. The roots of Swiggy trace back to an earlier venture by the founders, Bundle, a courier aggregation platform launched in 2011. But by 2014, seeing the potential in food delivery, they pivoted. Bundle was shelved and Swiggy was born, combining technology and last-mile logistics to redefine food delivery in India. Swiggy's journey to the public markets was longer. It finally went public in November 2024, listing at 8% premium. Over time, Swiggy has also diversified its offering to cater to the evolving needs of urban consumers. Swiggy's food delivery remains its core business. The company has continuously innovated in this space, notably with Bolt, an express 10-minute food delivery service in over 500 cities, which now powers approximately 12% of Swiggy's food delivery orders. Then, though Instamart, delivering groceries and essentials, Dine Out, which includes restaurant reservations and event ticketing, and several others like Swiggy Mall, Swiggy Genie, and supply chain and distribution. In short, Swiggy entered later but disrupted the space with its full-stack delivery model, managing logistics in-house from day one. This gave it unmatched control over speed, reliability, and service quality. It didn't just deliver food, it delivered consistency. Now, let me give you a better picture. Zomato went public in 2021 while Swiggy entered the markets 3 years later. Despite the late start, Swiggy initially outpaced Zomato, ending FY23 with 8,265 crore rupees in revenue versus Zomato's 7,079 crore rupees. But from FY24, the momentum shifted. Zomato's revenue jumped to 12,114 crore rupees in FY24 and 20,243 crore rupees in FY25, driven by Blinkit's rapid growth and better monetization. Swiggy, in comparison, posted 11,247 crore rupees and 15,227 crore rupees in those years. The real breakthrough? Zomato became profitable in FY24. Swiggy is yet to turn profitable, though it's improving steadily. So while Swiggy led early on, Zomato has taken the lead in both revenue and profitability, and the gap is growing. Now, by this time, all of us know that India's food delivery space is dominated by two giants, Swiggy and Zomato. But when we look at their core offering, which is food delivery, let's understand how they stack up against each other. In FY25, Zomato clearly takes the lead in terms of gross order value, clocking in 38,645 crore rupees compared to Swiggy's 28,783 crore rupees. Interestingly though, Swiggy has a higher average order value at 512 rupees versus Zomato's 453 rupees, indicating that while Zomato serves more users, Swiggy caters to higher value orders. On profitability, Zomato shines again, posting an impressive adjusted EBITDA of 1,505 crore rupees, far ahead of Swiggy's 566 crore rupees. When it compares to user engagement, Zomato again takes the upper hand with 20.6 million monthly transacting users, while Swiggy lags at 14.7 million. Zomato also partners with more restaurants, having 3.14 lakh restaurant partners versus Swiggy's 2.51 lakh. In short, Zomato leads on scale, reach and profitability. Swiggy wins on order value per transaction. Now, with both players aggressively investing in customer experience and loyalty programs, the food delivery war is far from over. Now, let's zoom out for a bit and understand the services. This is because the food delivery market itself continues to expand rapidly. According to Redseer, the Indian food delivery market expanded from 11,200 crores in 2018 to 64,000 crores in 2023. It is projected to grow further to 1.4 to 1.7 lakh crores with an annual growth rate of 17 to 22%. And both the companies are fighting tooth and nail for their share of the growing pie. While the growth is enormous, let's see what the management of Zomato and Swiggy have to say about it. Zomato expects its food delivery business to grow over 20% year on year thanks to more users ordering more frequently. They're especially focused on increasing their base of power users, the ones who order more than 50 times a year. With most of the big investments already made, profitability is improving too. Adjusted EBITDA margins are expected to settle around 5% of GOV. Swiggy is aiming for 18 to 22% annual growth in food delivery over the next few years. They believe the next wave of growth will come from innovation and getting new users on board and creating new reasons for people to order food. A big plus, users who join through Swiggy Bolt, their fast login and payment feature are sticking around longer, which is a good sign for the future. Both Swiggy and Zomato are aggressively competing in the quick commerce segment. Now, quick commerce is delivering groceries and essentials in minutes and has become the next big battleground. Here's how they stack up. Blinkit leads on most metrics. Its gross order value for FY25 stood at 28,274 crore rupees, almost double that of Instamart's 14,683 crore rupees. It also handled more orders, 42.4 crores compared to Instamart's 28.6 crores, and served 10 million monthly transacting users, ahead of Instamart's 7.1 million. Even its infrastructure is larger. Blinkit operated 1,301 dark stores, while Instamart had 1,021. However, Instamart has higher average order value at 512 rupees, while Blinkit's was 664 rupees. A sign Blinkit's order may be larger in quantity or more premium in nature. Both businesses are still loss-making on the EBITDA front, but Blinkit is closer to break-even with the loss of 1,381 crore rupees compared to Instamart's 2,094 crore rupees. Now, all in all, Blinkit is ahead in scale and order volume, while the Instamart shows strength in order value per transaction. With both players aggressively expanding, the quick commerce war is just heating up. Likewise, the quick commerce industry also is expected to see rapid growth. Having grown at a CAGR of around 148 to 169% from 2018 to 2023, the quick commerce industry is expected to grow further at 60 to 80% up until 2028, showing the importance of growth and potential of quick commerce players. Now, let's look at what the management has to say. Zomato's quick commerce arm Blinkit is riding an aggressive expansion with plans to scale up to 2,000 stores by December 2025. The customer base is growing rapidly as coverage deepens across cities. While investments will continue in the near term, the company expects adjusted EBITDA to stabilize at 4 to 5% of GOV in steady state, even as competition remains intense. Now, Swiggy's Instamart is also in rapid expansion mode, but with a shift in focus after hitting peak losses in late Q4 FY25. Management now expects contribution level break-even within 3 to 5 quarters. The plan: drive higher average order values, improve take rates, and densify their network through initiatives like Mega Pods and Max Saver. Despite high competitive pressure, Swiggy is confident about narrowing losses and hitting EBITDA break-even in sync with Instamart's turnaround. When it comes to financial performance, the contrast between the two companies in FY25 has been quite telling. Zomato reported a total revenue of 20,243 crore rupees for FY25, making a substantial 67% year-on-year increase. In contrast, Swiggy's revenue for the same fiscal year was 15,227 crore rupees, showing a growth of 35% year-over-year. A significant divergence is seen in their profitability. Zomato achieved a net profit of 697 crore rupees in FY25, a remarkable 139% increase compared to previous year. However, Swiggy continued to incur losses, reporting a net loss of 3,117 crore rupees in FY25, which winded by 33% year-on-year. Now, if you've been tracking these stocks in 2025, you've probably noticed it's been a roller coaster year for both the companies. Zomato or Eternal is trading around 230 rupees levels and has been marginally up from its debut on the market. In the last 1 year, it has witnessed an increase of 11% and a mere increase of 9% in the last 5 years. But if you are a Zomato IPO investor, Zomato stands strong with 236% returns from its IPO price of 76. Now, Swiggy on the other hand has had a rough time in the markets. After its IPO in November 2024, the stock has steadily declined and now trades near 52-week low. If you see its returns from 2025 so far, the stock is down by about 43% year to date. From Swiggy's IPO price of 390, investors would be in a current drawdown of about 20%. Both Zomato and Swiggy have smartly used acquisition to grow beyond just food delivery. In August 2022, Zomato made headlines by acquiring quick commerce startup Blinkit for 4,447 crore rupees. These bold moves helped Zomato enter the booming quick commerce space, and it's paying off. Blinkit is now a major growth engine. Swiggy, meanwhile, followed its own playbook. It acquired Dine Out, gaining access to over 50,000 restaurant partners and entering the dining out business. It also picked up Super Daily and built Instamart to tap into daily essentials and grocery delivery. These moves show that both players are thinking bigger, aiming to become full-fledged food and grocery tech platforms and not just delivery apps. The food delivery and quick commerce space in India is still in its growth phase, with immense potential ahead. As we mentioned, Citi believes that the food delivery market will likely increase at a compound annual growth rate of 15% for a decade, transitioning to a market of $26 billion in FY34. And for quick commerce, the growth trajectory is even steeper, with projections suggesting the sector could grow 24 times to reach $7.1 billion by FY25, despite concerns about market saturation and regulatory challenges. Now, both companies have ambitious plans. Zomato is focusing on D2C expansion of Blinkit and continuing to improve profitability across segments. They're working on increasing average order value while reducing the delivery cost through tech optimization. Swiggy is aiming to double its dark store area for Instamart despite widening losses, betting big on quick commerce segment. They have taken steps to increase market share by launching Bolt, aggressively dark store expansion, carving out Instamart as a standalone app, and launching Snack. Despite progresses, there are some challenges that we need to talk about. Increasing competition from entering players, regulatory scrutiny, particularly around gig worker protections, need for continuous technological innovation, pressure to improve unit economics while maintaining growth. The Zomato versus Swiggy battle continues to be one of the most fascinating corporate rivalries in India's tech landscape. While Zomato currently holds the edge in terms of market share and profitability, Swiggy is not far behind and continues to innovate and grow rapidly. For consumers like you and me, this intense competition means better services, more options, and sometimes even lower prices as both companies vie for our loyalty. And as investors, it presents two different but compelling investments. These one centered around proven profitability and market leadership, and another focused on growth potential and closing the gap. And as we move on through 2025 and beyond, the food tech battle will likely intensify further as both companies expand into new verticals and geographies. The only guaranteed winner, the Indian consumer who can now order practically anything just a few taps on the smartphone screen. So what do you think about these food delivery giants? Are you team Zomato or team Swiggy? Let me know in the comments below. Having said this is Neha signing off.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.